Now I would like to turn it over to the moderator of our very first webinar in the Global ABS Summer Warm-Up Series, Richard Hopkin, Managing Director and Head of Fixed Income Capital Markets for the Association for Financial Markets in Europe. Over to you, Richard.
Thank you, Jade. Welcome, everybody. It's a shame not to be in Barcelona today, which is, of course, is where we were all hoping to be at the beginning of this year, and to be in grey, wet London, although the weather has picked up a little bit here in London this afternoon, and I understand it's forecast to rain in Barcelona, so maybe it's not too bad. But nevertheless, it's a real pleasure to be able to launch this very first in a series of virtual webinars as part of the Global ABS Summer Warm-Up Series, with a view then to hosting, of course, virtual Global ABS in September, as you all will know. The topic today is the final report of the High-Level Forum on Capital Markets Union. Is it good news for securitization? The report was published last week, and some of you no doubt have already read it. I encourage everyone to read it, even if you just read the securitization part and the preface. It makes many recommendations across a very, very wide range of issues across the whole of capital markets. It's about 129 pages altogether. The securitization section is about 12 pages, so just under 10% of the entire report, and it's very, very detailed. It even includes some legislative drafting amendments for those of you who are keen to dig into that sort of thing. The recommendations, I think it's fair to say, have been positively received by most people in the industry, although not always positively received by some of the industry's critics, but perhaps we'll come back to that. Anyway, encouraging as they are, the recommendations are just that. They are just recommendations. So let me introduce our panel, all of whom have many years of experience in securitization and are well known to many of you. They are all members of AFME's securitization division and very engaged in our work, for which I cannot thank them enough. Their institutions have, in one way or another, been deeply involved in the work which went into the final report of the High-Level Forum. So they are all very well qualified to walk us through the key recommendations, explain their significance, and consider what happens next. Alexander Batchvarov is Managing Director and Analyst at Bank of America, where he leads a team covering the mortgage securitization and structured finance markets in Europe, Asia, and Australia. His team has been consistently ranked among Europe's top securitization research teams by Institutional Investor. Remy Haimet is a Managing Director at Societe Generale, where his role is to monitor new regulations and their effect on the global activities of the bank, especially in securitization and specialized lending. Alexandre Linden co-heads the portfolio management team in the Securitized Products Group at BNP Paribas, which manages a multi-billion portfolio of asset financings covering a wide range of asset classes funded via ABCP, term funding for middle market SME loans, and ROEs pools. So gentlemen, welcome and thank you for joining the panel today. Now, just before I go to Remy with my first question, let's take a moment. I don't know if the poll is working, Jade. Here we are. All right. So the polling question is, given the strong support for securitization expressed in the final report, how optimistic are you that we will see meaningful regulatory reform to enable the market to grow? And there's a range of options from glass half full to glass empty. Very optimistic, somewhat optimistic, ambivalent, somewhat pessimistic, and very pessimistic. So please fill that in at your leisure, and I'll turn to Remy to start. And Remy, I'll ask you, perhaps by way of introduction, to tell us a little bit about the High-Level Forum. You know, what sort of group is it? You know, who are these people? Why was it set up? And why is it important?
Thank you, Richard. Yes, I think also that this report is great news for securitization. It's far from being enacted in regulation, but it is a positive step for securitization. Now, the purpose of this forum was to restart the Capital Market Union initiative, which dates back now to a British commissioner, and has been, let's say, a bit of a disappointment in the last few years, but it was seen by the new commission as something that needed to be revived. And last year, the commission set up this high-level forum with 28 very high-level executives from various backgrounds, some of them, including Societe Generale's chairman, Lorenzo Bini-Spaghi, come from the banking industry, but they came from various horizons, as you can see in the report. Now, just for further background, there is this high-level forum, and there was a high-level group also that was set up by 3 member states, Germany, France, the Netherlands, with the same subject. So sometimes it's a bit confusing, but this high-level forum has been working for many months now, and it started long before COVID, but their work became even more important with the COVID situation and the necessity to finance all the restart of the economy. In the group, it's also important to see that there were many observers like the EBA and the ECB, so it was not just a free-for-all of industry lobbying. There were, I understand, very lively discussions of many subjects, and as we can see in the report, consensus was not reached on all subjects. Now, for securitization and other subjects, there were experts who helped formulate some of the recommendations. What we were asked to provide very specific regulatory amendments. That's why you mentioned specific write-up for the regulations. The objective was that the report should not only be based on general principles. But I will add that the forum was not the right place for a comprehensive and detailed rewrite of the regulation. You know, it's not like it was in our hand to propose a fully baked securitization regulation. What was important is more the direction of the recommendations, and that's where I think they are very positive for securitization. And finally, I will add one more little thing. I was, of course, not a member myself of the HLF. My chairman was, so I was only indirectly associated with some of its work. And what I said today is only my opinion. It doesn't reflect the official HLF position or Societe Generale position. Thank you, Richard.
Thanks, Remy. Fully understood, and you're right to clarify that. Also, just a reminder for everybody: this discussion is fully on the record. Press, it's open to press, so please, everyone, be aware of that. I'm going to turn now to Alexandra Linden and ask you, Alexandra. Do you have any sort of reflections on your involvement in the group and the sort of perspective from which it was approaching this topic?
Yes, no, definitely. And I would say the positive news is that securitization is being discussed and considered at this very high level, which involves, as mentioned by Remy, very senior people in our bank or in other parts of the industry. And why is that? I think this is an acknowledgement and a recognition that securitization, which could be viewed as a technical matter, is actually much more than that. It's core to the real economy in Europe. Beyond the financing techniques, we have real economy assets. We finance day-to-day mortgages for households, consumer loans, car loans, and also we finance corporates, SMEs. So this is recognized by the authorities. I would say that the other aspect is that it is viewed as core to the CMU, this Capital Market Union project. And why is that? Because the securitization market is actually the place where the financing of these assets, real economy assets, is being shared with institutional investors, be it asset managers, pension funds, insurance companies. And this is what is needed to be developed mostly in Europe. It is the way by which the originators, which could be banks, but also corporates, non-bank lenders, can benefit from much better funding conditions. And it is also a way for banks to transfer the risk and free up their balance sheet to provide more lending to their clients. I would say the only negative aspect, in my view, is that there has been already some efforts in the past by the authorities to promote securitization. We had the STS legislation. At the time of the STS legislation, the Commission announced that they expect that the market will grow. They may even mention a number of 50 billion per year of new issuance in the market. And AFME has actually published yesterday their quarterly report on the securitization market, and we can see that this has not happened. And actually, last year, the market has even declined. So I would say we really need a push from the authorities to go beyond what has been done so far.
Thank you, Alex. That's really helpful, and thanks for the plug for the AFME securitization report, which, as you say, for Q1 2020 was issued yesterday. It's got a fresh new look. Please do take a look at it. We've given it a bit of a makeover, and we hope it's a little bit easier to read and looks a little bit more modern. So please take a look and send us your feedback. Right, I'm going to turn now to Alex Batchvarov, if I may. And Alex, this work is something that you've been following very closely, and there are 7 sort of key recommendations in the securitization section. We're going to try to get through most of them today. We may not have time to do them all, but can you just sort of outline quickly for us what the key recommendations are, please?
Sure, Richard. Let me put it in the context of what you said earlier. The whole report allots about 10% of its volume to securitization. The report itself provides 17 clusters of recommendations which are meant to remove the biggest obstacles to the capital markets union building and functioning in Europe. And one of the 17 clusters is associated with securitization, and there are 7 recommendations. They're named game changers. Of course, that's a very powerful word, and we do believe that they will provide the support for the market. Whether they'll turn out to be a real game changer would depend on a whole host of other factors, but they are certainly a very good starting point. And as Alex Linden mentioned earlier, there have been a lot of discussions around what needs to be done to boost the securitization market in Europe. And many of these 7 recommendations have been around and discussed by the industry, between the industry and the regulators for quite a few years. Very briefly, they include significant risk transfer, the issues with capital calibration, solvency to capital calibration, SME securitization, the equivalence or differences in the treatment between cash and synthetic securitization, the LCR treatment of STS and broader securitization market, and last but not least, the disclosure requirements. Now, I would like to put these recommendations also in a slightly different angle. As we said, all 3 of us indicated they have been discussed as this has been an action going on for quite a few years. And in the last few years, the adoption of STS did provide a new boost to securitization. that didn't materialize, as Alex Linden mentioned earlier. So these new measures, in my view, are the measures that need to complete the securitization STS reform that started, and by completing it, provide the necessary framework for the securitization market. I also want to reference another angle, which is Remy mentioned the work of the high-level group, which was last year in September, October, which preceded the high-level forum. And that group also endorsed the need for securitization, but it also highlighted the need for level playing field between securitization and other comparable instruments. Many of the 7 recommendations are also going in that direction. Until we level the playing field between securitization, underlying exposures, covered bonds, sovereigns, and so on, it would be difficult to see the market really restart and achieve the levels which it needs to achieve. Last but not least, I want to emphasize that the securitization cluster is part of the creating a vibrant and competitive business environment. In other words, the high-level forum believes that we cannot have a vibrant and competitive business environment. We cannot really boost the funding for the economy unless we restart the securitization, and it is one of the 7 clusters in that broader push for business environment capital markets union.
Thank you, Alex. Very clear, as always. Let's dig a little bit deeper now. Actually, just before we do that now, let's just pause for a second. I think we can now go back to the poll results from the polling question. So hopefully everybody can see those on their screens. So we see, I think this is a moderately optimistic outcome. I think people are not expecting anything to happen perhaps immediately, or they're not expecting nothing at all to happen. But people seem to be pretty clustered around the middle of the distribution there, with a bias towards end of what did I say? Oh, sorry. A bias towards being somewhat optimistic. Yeah. That's all good. Thank you. All right. Now let's dig a little bit deeper. So I'm going to turn to Alex Linden, if I may, and Alex, ask you to talk a little bit about the first 2 of the 7 recommendations that Alex Batchvarov just mentioned. Significant risk transfer and recalibrating bank capital charges applied to senior tranches, because they sort of go together. I mean, SRT, I know it's been a topic that AFME has been very engaged with over the last 2 years or so, and discussions are continuing. I think it's fair to say that there's been some progress in those discussions, but hopefully the inclusion of SRT as a topic in this report will give everything an added boost. So why don't you just walk us through some of those details?
Sure. Yes, definitely. Just before going into details, that those 2 topics are closely related to the role that banks are playing in this market in Europe. They have a very active role, whether they originate and securitize their own assets for funding, or they do this SRT transaction, by which they share the risk with mostly non-bank investors on the mezzanine or junior tranches, and they retain the senior tranche. They also are very active in funding corporate clients through ABCP vehicles, and enables them to benefit from a low funding cost. And finally, they're also quite key in the secondary market by allowing market making. Hence, it is very important that the rules applying to banks are adjusted to make it work. On the significant risk transfer, I think the issue has been historically that the text in the CRR is quite clear that there are 2 quantitative tests about how to transfer the risk. And it is about selling either 50% of the mezzanine tranche or 80% of the first loss tranche. And in addition to that, there is a mention in the CRR that the competent authority, so ECB for European banks, Euro area banks, would also be able to assess if there's been a commensurate risk transfer. And the view was that this additional check was, let's say, on top of the quantitative test, but it was not very clear in the legal text to what extent it could be done systematically, or it should be done more specifically for more complex transactions, which was, we think, the expectation. But over the time, the ECB has taken this as its mandate to check ex ante each transaction, and as a result, there is a long process with the ECB, which has some uncertainty and creates difficulties for banks to in fact plan such transactions, and which are very key for their capital management. And there have been cases, it depends on each bank, on each asset class and transaction, but there have been cases where unexpectedly at the end of the process, the ECB has come up with new criteria, ask a buffer or a new test, which is clearly not coming from the CRR. So the view is that if we need to make this process work better, as mentioned also by Richard, obviously dialogue with the ECB is key, and this has been done through AFME. But at the same time, there needs to be a clear legal clarification about when is this commensurate risk transfer required? Is it required only in cases of complex transactions? Could it be avoided for simple repeat transactions? And this is where it would be extremely helpful if the Commission could come up with such clarification. And this is the first, I would say, recommendation to allow a much, let's say, smoother process for SRT.
Thank you, Alex. That's very helpful, and I think it's important to acknowledge that I think there has been good progress in the discussions we've been having with the ECB, in particular, on the whole SRT topic over the last 18 months or so, for which we thank them, and let's hope that that will continue to be the case, and that the approach recommended in the final report will indeed be taken up. I'm going to turn now to Alex Batchvarov and ask him to comment. We heard from Alex Linden about the banks, but just as important, of course, arguably more important, is the insurance sector. So I'm going to ask Alex to walk us through that for a few minutes, and then after that, I'm going to see if there are any questions from the audience. So if people have any questions, please do start putting them into the Q&A now, and hopefully we'll be able to see them. So Alex Batchvarov, 12:02.
Okay. Thank you, Richard. Yes, insurance is another aspect, one of the 7 key recommendations, and it is related to addressing the capital calibration, the capital charges for securitization. Solvency II is a perfect example of the incompleted work of the introduction of STS. As we all know, with STS introduction, capital charges were recalibrated for senior and non-senior STS securitization. But there was no mandate at that point in time to recalibrate the capital charges for the non-STS securitization, which led to a massive capital gap between STS and non-STS securitization. So that work has to be completed. On the other hand, we are also concerned about the level of calibration of capital charges for non-senior STS securitization, which also requires additional work. The result is very clear. We track the performance of the investment of insurance companies. They represent about 85% of the insurance business in Europe. And with the latest data from 2019, we see that their holdings of MBS and ABS have declined down to 2% from close to 10% after the financial crisis, where their holdings of residential mortgages and direct loan exposure stand at around 9%. Their holdings of covered bonds are around 6%. So the decline in RMBS, ABS holdings, in our view, is a direct result of this miscalibration of capital. To a large degree, that's driven by the different methodologies used for calibrating capital for residential mortgages versus residential mortgage securitization. And this is, again, another example of how the playing field must be leveled for capital recalibration. And here we are looking at the whole continuum, again, of securitized bonds, senior, non-senior, STS, non-STS, residential mortgages, covered bonds, and corporates. Richard?
Yes, thank you, Alexander. That's very concise, as always. Alex, I think you said you had one point you wanted to add?
Yeah, sure. Actually, there is the same recommendation, not for insurance companies, but also for banks, for the capital applying to banks, to recalibrate it, especially for senior tranches and in line with the risk profile. As you may know, the current formula, whether SEC IRBA, SEC SA, or even the SEC IRBA for ratings, results in quite punitive risk weights, even for senior tranches. And this is mostly driven by the way they have been designed with this, for instance, P factor. And this has been designed at the time to capture very severe credit events such as the subprime crisis. But I mean, I think we all now recognize that, especially in Europe, there's been a much better performance of the assets. And a lot of this calibration is unduly punitive. To give you an example, if we even look at what's happening in the United States, where the SEC SA, the formula for standard, has a P factor of 0.5 for all transactions, because there is no kind of STS, differentiation in the US for the time being. Whereas in Europe, the SEC SA has a P factor of 1, reduced to 0.5 for STS. So similar to every other transaction, US transaction, when you achieve STS. And this even 0.5 is actually very punitive. It means that you consider that the risk of the pool is higher securitize it than if you had not securitized it, which may not be at all realistic if you have a prudent underwriting, if you know your transactions well, which is the case of most transactions we do or we finance. So the view has been that we should really differentiate more and have a more favorable treatment. Reduce, for instance, the P factor to around 0.25 for STS and 0 for non-STS, and also have lower.
Thank you, Alex. Sorry, I'm just a bit mindful of the time because we've got about 15 minutes to go and we've still got quite a lot to cover. So thank you for that. I think the point is well made. We've got a question from Merin Kraska at Mayer Brown. Thank you for your question, Merin. The question is, the recommendations seem to be a very positive step forward. What is the panel's view on how likely it is that these recommendations will be implemented? Perhaps I'll go to Remy in the first instance, because Remy, you're not getting your fair share of airtime on this at the moment. So here's your chance to redress the balance.
Thanks, Richard. I think it depends on which recommendations. Some of them could be implemented quite quickly. We may briefly mention them after, such as Sts Synthetics. Some of them are, in my view, in the hands of the Commission, including some changes to the insurance weightings or the LCR recommendations. And some others are probably going to take longer, including if we need to go back to the Basel Committee for risk weights. So I think the 7 recommendations give a broad brush type of recommendation to the Commission. I don't think they can all be implemented together, but some of them could be done quite quickly.
Fair enough. I mean, any other comments from the other panelists on that quickly?
Well, I mean, there are already some actions underway. Today it was announced that Basel will start work on the NPE securitizations with potential changes. That would probably help the process in Europe, given the preparatory work which EBA had already completed in that space. We will probably see some action on the synthetic securitization front also. For STS, there is an indication that the Commission would, the European Council put this as a forward measure. I think that I would agree with Remy. It depends very much on this interaction between the European Commission and Basel. But there is also another angle, which is the Parliament. And I think that while the current support is quite obvious, there's need to be probably more work done to get all the 3 parties, Council, Commission and Parliament on board of these changes, because some of them require level 1 documentation change.
Indeed. The Parliament was certainly the most challenging part of the legislative process last time round. So I think, we will need to, make our case cogently. Right. I'm going to have to press on. I know there are some other questions from the floor, but there are quite a few more things to cover, so forgive me. I'm just going to say a few words quickly about SME financing. That is included as one of the 7 key recommendations in the paper. It's perhaps the shortest section, but I think it's certainly, one of the most important. I always think that the role of securitization in funding SMEs is often underrated. People think of securitization for SMEs as just being securitization of SME loans, but of course it's much more than that. It's asset-backed commercial paper, it's leasing transactions, and so on. And I think financing of SME loans can be difficult to do in the cash markets because of the way the loans are structured. They're often revolving. They're often tied to other bits of business that the banks undertake with SME borrowers. But they are very, very consumptive of capital on the balance sheet because they do tend to be high risk. And that's why I think the sort of holistic approach that's proposed in this paper, with a combination of freeing up the cash securitization markets and also a big push for SCS for synthetics, I think will really make a difference there. The recommendations in the paper for SMEs are largely around data collection and disclosure. There's a recommendation to establish a version of EDGAR in the EU, and also to delegate some level 2 powers to ESMA and the EBA regarding credit data and filings. I think if that information is gathered centrally in one place, it can only help the ability of securitization to help finance SMEs, I think, and indeed for SME financing generally. And I think this all comes back to the phrase that Alex Batchvarov used a moment ago, creating a vibrant and competitive business environment. I'm going to come back to Remy now, and just that's actually a neat segue into the whole sort of cash and synthetic debate. One of the recommendations, of course, is applying equivalent treatment there, Remy. And again, this is a topic that AFME and our members have engaged in extensively with the EBA. And the recent report of the EBA was, I think, quite helpful. And that is now currently with the Commission. So would you like to share some of your thoughts with us on that topic?
Yes, this report from the EBA, I think, was quite good, and it came right when the HLF was finishing its work. So in a way, we're just confirming what the EBA has recommended, which is to extend the STS treatment to synthetic transactions in general. I think synthetic have been blamed unfairly because the name carries a negative aura, but we're talking about a financial guarantee, to make it simple, rather than a true sale of assets. It's not there's nothing bad about it, and it's very useful for some structures. In any case, the EBA has recommended extending the STS treatment. What they could not quite recommend is that the STS transaction should also carry a lower risk weight. That's where we're expecting the Commission to make a positive proposal. It would probably open the market a bit more to banks, particularly in these difficult market conditions now. So I think it would be positive for the volume in the market. And this could be done. Maybe the Commission could be proposing something in the next few months, even in July. We don't know what the reaction of the the Parliament or the Council will be.
Thank you, Remy. I think it's certainly helpful to the Commission that they have the sort of backing, if you like, of the EBA on large parts of this. So I think you may be right. We may see something sooner rather than later on STS for synthetics. Thank you. LCR is another really important subject, and you know, we've been faced with new rules on the LCR that came into force just a few weeks ago, which have been really very unhelpful, as we knew they would be. And I feel like I've been, preaching on this subject to the authorities for a long time, and we haven't been given any kind of relief on it. So it was good to see this topic in there. Alex Linden, I think Alex Linden, but you were going to take us through this one, weren't you?
Sure.
Right,
yes, definitely. So quickly, yes, I think it's been one of the disappointments, this one, because with STS, there was really the hope from the industry that there would be a better treatment of securitization under LCR, which would be quite similar or level playing field with covered bonds, because covered bonds have actually a treatment whereby they can be eligible to the various HLF buckets up to almost the highest level, depending on their rating. Whereas actually for securitization, it's only the level 2B, and it's actually even more restricted now, because it's only STS that is eligible, plus at the moment only AAA, which is even tighter than what it was before STS. So definitely, there is a need to review to make it more competitive, align it with covered bonds, allow non-STS to be eligible, allow non-AAA to be eligible, which is a key issue for also banks in Spain or Italy or countries which cannot achieve AAA for sovereign ratings. And it's an issue. I hope it's one where there could be some quick fix, especially on the rating side, because as mentioned by Richard, it has only been, let's say, implemented since May, and by end of June, there will be the first LCR reporting under the new rules.
Thank you, Alex. Any comments from the other panelists on the LCR aspects?
Just one addition. There's a part of a recommendation which was not included in this document, and that, in my view, is a recommendation which should go to the European Central Bank with regards to reflecting the STS reality in the repo eligibility and respective haircuts. And that is potentially another aspect which needs realignment between CRR and banking, central bank monetary policy regulations.
Yes. No, definitely. I think it would be quite much simpler for the market to harmonize the criteria between ECB and LCR. Yes.
Thanks both. Alex, I'll come to you for the last of the 7 that we wanted to cover. I think we can go a little bit over the 45-minute limit. It's not like Barcelona where we have to clear the stage for the next panel. So we have a little bit of flexibility if people are willing to bear with us on that. Alex, why don't you comment on the disclosure and due diligence requirements and this, again, a long-running issue about private versus public securitizations.
Yes, and I'll take the chance to answer one of the questions coming from David Saunders with regards to the significant cost of implementing ESMA templates for synthetics, and is there a short-term exclusion chance for synthetic securitization? Yes, the recommendations effectively reflecting what we have been discussing for the last few years. The interpretation of level 1, do the templates and this level of disclosure apply for private securitizations? How about synthetic securitizations? How to apply the ND fields? At this point in time, there is no clarity, but I think the recommendations are fairly clear. I hope that the publication of the RTS on disclosure and the so-called ESMA templates are potentially delayed. I have no information, but maybe delayed just to address some of these issues, fingers crossed. But I do not have a firm answer, David, to your question whether we're going to get short-term exclusion for synthetics. And it is widely recognized, and we mentioned that mentioned in the report, that the templates are difficult to apply for synthetic securitization. In addition to these requirements for disclosure and templates, there are 2 other points that are mentioned in that recommendation. It's related to third country securitizations, whether they should meet the exact same disclosure requirements or templates. And the second one is related to legacy portfolios. The due diligence and the reporting on these legacy portfolios, if it's simplified, would probably open the market for buying and selling loan portfolios, which would probably be very important given the current economic situation and the need for the banks to address balance sheet constraints going forward. So these are the main aspects of the recommendation, Richard.
Thank you, Alex. Okay, let's go back to the audience. We've got one question that I'd like to cover from Alexander Woodgren. What would the effects be of pushing regulations such as STS until 2022? Do we anticipate new innovation from fintech companies to emerge during these times? I think, Alexander, what you mean is what would be the effect on the market if we have to wait until 2022 for some of these reforms? I think that's what you mean. I hope that's right. Any thoughts from the panel?
Well, I mean, I would say that we've been asking for these changes for many years. So, I mean, obviously, we can survive without them. But the reality is that the market has been shrinking or not growing as we would expect it would, and very well below what is happening in the US market, where it is like 4 or 5 times bigger. And especially now with this COVID crisis, things would become more difficult as well. So to me, the more we wait, the more we prevent the development of this market.
Anybody else? Thoughts? How much resilience do we continue to have? I mean, I sometimes think the securitization market is a bit like the Welsh language. It's amazing that it survives at all after the attempts of the English over the last 2,000 years to stamp it out until quite recently. But it's a little bit like that. What do you think? Is the tide turning at last?
Well, I mean, the tide seems to be turning, but it doesn't seem to be turning in many respects broadly enough. So, for example, the quick fix with regards to NPE, if we get that in the next 3 months, would that have a material effect on the securitization market? Probably not, especially seeing how the NPL securitizations are performing in this environment and all the measures adopted to fight COVID economic fallout are having a negative effect on that. That is probably going to widen the prices. Would the securitization improvement fix that itself? Difficult to say. Number two, the securitization market is generally requires a primary market for reference of pricing. If we don't have continuous price referencing for the primary market, it's very difficult to determine the pricing. And we saw that in the second half of March and early April. So one cannot take only one aspect of the market and believe that's going to develop. The whole package of these proposals and reforms have to be introduced, at least, if not simultaneously, at least concurrently in a very short horizon in order to actually boost the market. And last but not least, let's not forget that today TLTRO draw was more than 1 trillion. So securitization is not a liquidity need, it's a capital funding need. The positive things we're seeing in the market is the increase in SRT and CRT transactions. And one of the questions Alexander Wingren asked about the fintech companies, they probably don't need STS. They could provide get the funding model work, get the information work, and still get the market if the broader market is working and the pricing is there.
Thank you, Alex. I think I've got one more polling question. I hope we've got a little bit of time to do it. So, so Jade, I don't know if you could. Yes, that's up. Thank you. So this is our last poll, and then whilst you're answering that, I'll come to the panel with one last question, which Alexander Batchvarov has sort of partially answered already, but that's okay. So the polling question: how soon do you expect to see this regulatory reform to be delivered? By the end of this year? By the end of next year, by the end of 22, or after that? So if you could please have a think about what your estimate is, that would be good. And I think the last question I have for the panel, and I'm sure you'll all hate this question, I know for a fact that Alex Petrov does because he just said so. The question is going to be, if you could only choose one of these 7 recommendations, which one would you choose? You know, which is the one most likely, you know, to keep the securitization market going? You know, some people, some of our members say to me, oh, you know, the LCR, if the LCR was fixed, that would be transformative. I was speaking to a member just yesterday who was saying, you know, everyone is saying that, you know, it's the need to, or it's the lack of recognition of different disclosure requirements for private deals that is holding everything back. There's so much business to be done there privately, you know, but it's very, very difficult to meet the disclosure requirements. So what do the panel think on that? Maybe I can start with you, Remy.
Sure, thank you, Richard. In a way, I agree with Alexander Batchvarov. In an ideal world, we would need everything. The problem is it doesn't work like that. You know, having worked with you over the last few years, we know there are obstacles everywhere, but whether it's EBA, Basel, the Parliament. And I think one little step at a time is still a positive. Let's take what we can. You know, if the European Commission can get some things moving now, better than wait. But it's true that I don't see any magic bullet in any of those recommendations. For the market to move forward, we need a lot of things to go right. We need LCR, we need better capital regulations, we need synthetic SDS, I don't know, a lot of things need to move, and we'll still be far from the US after all this is in place.
Right, so you'd agree with what the report says, and you know, the report says this in a much bigger context. You know, it says that all the recommendations in the report need to be taken together to get Capital Markets Union to really function. Yes. So you'd agree with that in the context of securitization?
Yes, securitization and the others. You know, there are so many obstacles to make real European markets that we could just give up. But
Good. Alex Linden, any thoughts?
I mean, as you know, we've been many years to improve capital calibration, and we know it's a long, long battle. And as also mentioned by Remy, it's not the first thing that would be changed because potentially through Basel. That said, the reason why we insist on that is we think it's really key, and it could be a game changer for the market, given the big role of banks in Europe in this market. And as well, I would say that if what we can see already, it happens in the various segments of the market, but there are the need to do transactions to finance the economy, to refinance portfolios, and if securitization is deemed to be too costly, too complex, too regulated, with then what happens is that market participants find other ways and do it in another structured finance way, which is not securitization. And I think this is already happening quite a lot in the private market, and it will continue until these things are fixed.
Okay. Any last words from you, Alex B?
Well, just one point. There was this enormous amount of work and support both from the Commission and EBA for the establishment of STS. That was the big initiative. And we saw that STS on its own did not really provide the boost that we were hoping for on the market. So the piecemeal approach does not work. We need to address all the issues together, or just see the continued attrition of the market in Europe.
Fair point. Right, well, let's just close by turning to the poll results, and 0 think that anything will be done by the end of 2020. And I think most 2/3 of people who responded think it's going to be later than the end of 2022. So we're looking at 2023 or later. Gosh. Well, let's hope that those low expectations are proved wrong. I think it's fair to say that there is, I think, a genuine and well-informed and intelligent concern in Brussels about the fact that securitization, since the implementation of the STS framework, has not really developed as might originally have been hoped. So I think there is a genuine amount of goodwill there to fix what needs to be done to make the market work in a prudent and sensible way, whilst protecting investors and of course learning all the mistakes of the past. All that almost goes without saying. So I think I think the glass is half full, but we need to fill up the rest of it. On that note, then, I think we'll conclude. Please, well, thank you, first of all, everybody, for joining, and thank you to the 153 who stuck with us until the bitter end. I hope it's been useful. Please join us for our next webinar, which I think is on the 30th of June at the same time, same place, where I think we're going to be doing a review of the market, if memory serves. So we hope you'll be able to join us then. In the meantime, I hope this has been helpful. Please tell your friends, and this webinar is available for 30 days if anybody missed it and would like to listen on catch-up. Thank you.